Imagine buying your own home without needing a penny for a deposit. Sounds like a dream, right? Or maybe, is it a financial nightmare we've seen before? For years, saving up a huge deposit has felt like an impossible task for so many people trying to get on the property ladder here, obviously in the UK. And we see average house prices around £268,000. And even a 5% deposit on that is a hefty £13,400. When you factor in the average rent, the typical living cost, and a standard average wage of £34,000 a year, which nets you about £2,300 a month after tax, finding hundreds of pounds to save each month is incredibly tough for a lot of people. My calculations have showed that after average outgoings, someone on that wage might realistically be only able to save around £200 a month. Now, at that rate, just saving, for example, a 5% deposit could take 5.5 years. And that's before we even talk about house prices potentially increasing while you save. Now, if we factor in a modest, say, 2% average annual price growth of housing, that same deposit target gets further away each year. And suddenly, that saving timeline stretches to around 6 years or even longer just to keep up. But now, no deposit mortgages are making a comeback. These are 100% loan-to-value mortgages, where you borrow the entire value of the home. But before you get too excited or too worried, didn't we see this right before the 2008 financial crisis? So in this video, we're going to break down exactly what 100% loan-to-value mortgages are, look back at their controversial past, and the lessons learned from the financial crisis, and crucially explore how the options available today are they a lifeline for frustrated buyers or a risk you should avoid. Let's find out. So let's start with the basics. Loan to value, LTV. That's simply the percentage of a property's value that you're borrowing from a lender. If a house costs £100,000 and you have £10,000 deposit, you need to borrow £90,000, which is 90% loan to value, LTV. Okay? So a 100% loan to value mortgage then means you're borrowing, 100% of the property's value. You don't need to put down any of your own money. And these are sometimes called no deposit mortgages or zero deposit mortgages. Now, on the surface, they sound fantastic, especially for those that are struggling to save that initial lump sum. And they're typically aimed at prospective buyers who can demonstrate they can afford the monthly repayments that lack the chunky savings that are needed for a deposit. Now, to understand why 100% mortgages are viewed with caution by many, we need to look back at the period leading up to the 2008 financial crisis. So in the years before the crash, the mortgage market in many countries, including the UK and the US, was very different. Lending criteria were often much looser. Lenders were more willing to offer high loan-to-value mortgages, including 100% LTV, and in some cases, even mortgages for more than the property was worth, known as 125% LTV mortgages. And obviously, we saw the pickle we got into with those. These mortgages, while seemingly helping people get on the ladder, contributed to a significant increase in household debt. Many borrowers with limited savings and sometimes less stable financial situations were taking on large mortgages. Now, the real problem emerged when house prices, which had been rising rapidly, started to fall. For those with high loan-to-value mortgages, a small drop in property value meant they quickly fell into negative equity. So, what is negative equity? Well, basically, it's when the amount you owe on your mortgage is more than your property's worth. It's important to get to grips with this. And this traps homeowners, making it difficult or impossible to sell, and definitely impossible to remortgage. Now, as more and more people found themselves in negative equity and struggled to keep up with repayments, defaults and repossessions soared. And this had a devastating ripple effect throughout the financial system, contributing significantly to the global financial crisis. The easy availability of high-risk mortgages, coupled with falling house prices and complex financial products tied to these mortgages, created a perfect storm. In the aftermath, 100% LTV mortgages largely disappeared from the market as regulators tightened lending standards dramatically. So if there was such a problem before, why are we seeing 100% mortgages again now? The key difference is how they are being offered and to whom. Today's market operates under much stricter regulations and lenders are far more cautious. And of course, the new generation of 100% mortgages are designed with lessons learned from the past. They often have very specific and stringent eligibility criteria. For example, some products are specifically aimed at renters who can demonstrate a strong track record of paying rent consistently and on time, obviously, for more than a year. And the idea there is to show that they have a proven ability to afford housing costs. Crucially, affordability checks are much more rigorous now. Lenders don't just look at your income, they do a detailed assessment of your outgoings and stress test whether you could still afford the mortgage if interest rates were to rise. And this is a significant change from some of the lessons in comparison to the checks done in 2008. Many of the current 100% mortgages also often involve a guarantor, a family member who provides additional security for the mortgage, sometimes by using their savings, putting it into an account, or putting up their home as collateral to reduce the risk for the lender. We're also seeing some new products offering longer fixed rate terms, perhaps 5, 10 or even 15 years, which provides, obviously if you're a borrower, much more payment stability and more time to build equity in your home, which can help mitigate that risk of negative equity compared to short-term kind of variable rate deals. While the headline 100% mortgage sounds the same, the actual underlying structure, the target of the types of borrowers, and the regulatory environment are very different compared to pre-2008. Now, despite the differences, it's vital to be aware that 100% mortgages still carry significant risks. The biggest one being negative equity. That's easily the most significant risk, because if property prices fall, you could quickly owe more than your home is worth. And while longer fixed terms and stricter checks aim to reduce this risk, it's still a possibility, making it difficult to move or remortgage if you need to. Now, the next is obviously higher interest rates. Because the lender is taking on more risk with no deposit buffer, 100% mortgages typically have higher interest rates compared to mortgages where you're putting down maybe 5 or 10 or 15% deposit. So that obviously means higher monthly repayments. There's also limited choice. Fewer lenders offer 100% mortgages compared to those that actually do need a deposit. And that limits your options for finding, competitive deals, so to speak. So now let's get on to the new type of 100% loan to value mortgages. There's ones out there that require you to be renting for at least a year. We've got the ones where they might require a guarantor. However, we've now got 2 lenders that came out just this week that offer full fat 100% lending. They're not going to look at your rental history. They don't want anyone to put a savings account in place with them. They don't want a charge over a different home. It's just a normal mortgage for 100% of the value of the house. Now, they're aimed at first-time buyers and they do carry significant risk. However, given how long it takes to save for a deposit, and given that house prices seem to be incredibly resilient, just think back over the past 5 years, we've thrown absolutely everything at the housing market, from a pandemic, an inflationary crisis, changes in governments, a war in Europe, Ukraine, higher interest rates. None of it seems to have done anything to the housing market, which is kind of testament to the checks that are now involved when people are taking out mortgages. Because without those checks, people might actually be in a real pickle. Now, that's not to say that obviously people are still struggling. Things are much more expensive. Mortgage rates are up. However, despite all of those things, the housing market has remained incredibly resilient. So clearly, these checks work. Now, what does it mean for you if you're struggling to save up? Well, there are a few things to be aware of. Number one, you're going to need an absolutely A1 track record in terms of your credit profile. It's going to have to be absolutely gleaming. We're talking no missed payments, no late payments, no CCJs, no defaults, no debt management plans, no arrears, nothing. It's going to, basically, you need to be a saint. Now, lots of people out there actually have that kind of credit profile. The next thing to understand is just because it's a zero deposit mortgage, it doesn't mean you won't need money. There are still things to pay like lender fees, legal fees, surveys, so you're still going to need some savings. However, if that means that you're able to take the first step onto the property market, get out of, paying thousands of pounds in rent, or maybe you're still living at home with your parents and you actually want to get out into the big bad world that we all live in, then this is potentially a genuine option. Now, of course, it's not going to be for everyone. I can't tell you whether you should do this or not. That's your decision to make. It comes with risks and they are significant. However, if you're in a situation where you just feel as though you're never going to be able to get that deposit together and you're worried about house prices kind of running away from you, you're getting older and you're panicking about not being able to buy a home, then this is your chance. So what kind of fees are we talking about? Right. So there are 2 lenders that are doing this at the moment, just a full fat 100%. I would say on average, you're going to be needing at least £4,000, maybe £5,000. That's taking into account, an average house price of kind of £250,000, £280,000. So if that's the kind of property you're looking at buying, then you're probably going to need 4 to 5k in fees. That's taking into account legal costs, booking fees, surveys, etc. Now, they generally only come with longer term fixed rates, a minimum of 5 years fixed, and in some cases 10 or 15 years fixed. Now, if you're thinking of buying with a partner, you do need to be kind of extra careful. Why? Well, most mortgages come with what are called early repayment charges. What that means is that if you want to get rid of the home during the fixed rate term, there's going to be a penalty to do that. Now, if you're not putting in a deposit, you won't have any equity. So that means that if you split up and you want to go your separate ways, there's going to be a cost. So you need to be really confident about doing something like this. As I mentioned, I'm going to keep saying this, it comes with significant risks. Because if you need to sell that property and you've borrowed, let's say you've borrowed the average house price and there's, let's say, a 5% redemption penalty, that's 12.5k you're going to have to find to get out of it, for example, in the first year. Now, of course, those penalties do come down over time, but nevertheless, this is a big commitment and you need to be absolutely confident that you're making the right decision, because if you don't, you can find yourself in hot water incredibly quickly. Now, if you're actually considering this, it's essential to understand that today's offerings are structured differently and operate within a much more regulated environment than the kind of high-risk lending seen before the 2008 financial crisis. And whilst they can help overcome the deposit hurdle, they still come with significant risks. I know I've said that a lot, but I need to drive this home. The risk of negative equity is significant. If you're considering a 100% mortgage, you really do need to do your homework. Research the specific products that are available, understand all the terms and conditions, and be brutally honest with yourselves about the ability to afford those monthly repayments, especially if interest rates rise, although you would be protected against that until your deal ended. You need to seriously consider, and I'm not going to get into trying to flog your insurance here, but you need to seriously consider making sure that you have the right protection in place. If you're jumping into buying a home, borrowing all the value of that home, 100% from a lender, it's all based on your income. If something happens to your income, i.e. it stops because you've either lost your job, or if you're unable to work due to illness or injury, then you're going to be in a pickle. So you do really need to consider that. Yes, you probably think you're bulletproof. Trust me, you're not. Life can throw some nasty curveballs at people, and when you don't have that protection in place, particularly if you're borrowing anything like 100%, I mean, this goes for anyone that's borrowing any mortgage, but particularly if you're borrowing 100% of the loan from a lender, then you seriously need proper protection, because doing it without, you're asking for trouble. And of course, most importantly, seek independent mortgage advice from a qualified mortgage advisor, hence me, because we're there to obviously assess your circumstances, look at the options, and help you make an informed decision whether that's the right thing to do, because it might not be. Don't let the difficulty of saving a deposit push you into a decision that isn't right for you long term, both financially and mentally. Now, if you found this video helpful, please give it a thumbs up and a subscribe for more insights into the wonderful world of the UK property and mortgage market. And let me know in the comments what you think. Do you think this is a good idea, bad idea, or will it all end in tears? See you later.